Thanks, Dave. My name, again, is Jim Higgins. I'm a principal with SES Advisors, and again, we're the folks who helped Dave and the other former shareholders construct this transaction that will result in you folks ultimately owning shares through the ESOP and having a retirement benefit that is tied to the success not of a mutual fund that might be investing in ExxonMobil or other things of that nature, but in the place where you actually work. So if you think about your retirement fund, your 401k plan, and it invests in, again, ExxonMobil, you go to the gas station, you fill up your tank, it's not going to move the needle on the value of your particular investment, which is the 401k plan. Conversely, with the ESOP, as we'll show you, the ESOP is a thing that you have a direct influence on what the ultimate retirement benefit is going to be. So the harder you work, the more profits that the company makes, the quicker you pay down the transaction costs associated with the transaction, the more value you're going to receive at the time that you retire. So, and again, as Dave pointed out, please, please, please ask any question that's on your mind. I was up in Vancouver yesterday, and we got some fairly interesting questions that were kind of off the cuff, but we'll answer anything you've got on your mind, because this is for you to understand. This is an educational program for you, the ESOP participants, to understand what the ESOP's all about. So the outline that we've got today, first off, we'll talk a little bit about how CHC is now 100% owned by the ESOP, talk about the transaction itself. We'll then delve into the specifics of an ESOP and explain what it means to be in an ESOP. Discuss what the plan rules are. Like a 401k plan, the ESOP is a qualified retirement plan, and there are specific rules about how you get to become a participant, what the vesting is, and when you receive your benefit. And then finally, we'll talk about the thing that's probably the most important thing, is valuation, and how do you increase the value of the stock, and ultimately when it comes time for you to retire from the business, what that means to you in terms of the value that you're receiving. So an overview of the transaction. The four shareholders of California Hydronics sold their stock to the ESOP. The ESOP was created. It was like a 401k trust that was created at the beginning of the year. And this trust went ahead and bought the shares of California Hydronics from the former shareholders. There was a trustee. If you think about a table where you have on one side of the table you have the company and the selling shareholders, and on the other side of the table negotiating is the trustee who actually is working for you, making sure that the transaction was done in a way that was fair for you folks, and in a way that will conform to what the requirements are from the federal government, because this is all sanctioned by the U.S. government. The Department of Labor and the Internal Revenue Service regulate ESOPs. And so this gentleman, Dan Reeser, who was the independent trustee, was the one who was responsible for doing the due diligence and negotiating the transaction. He had two people that was working for him. One was a financial advisor, which is an appraiser, who looked at the value of the company to make sure that the ESOP was not overpaying for it. And then there was an attorney who also represented the trustee in looking at all the different paperwork and executing the transaction documents. So those people were working for you. Dan Reeser is still working for you to make sure that what's going on with the ESOP is consistent with the way the federal government requires it to be. The ESOP now owns 100% of the company, and those shares were bought in mid-April, and they were put into a suspense account, and then they will be taken out of a suspense account over 20 years. So essentially 5% of the shares per year are going to be taken out of the suspense account and then allocated to the participants, the employees, for that particular year. And we'll get into the details of that later on. Excuse me. The really interesting thing about this is, because this is an ESOP company and it's 100% owned by the ESOP, the company no longer is going to be paying income taxes. So all the transaction costs that were associated with the buy that the ESOP bought the stock for, the cost of that, can all be paid back with the income of the company, and that income's not going to be taxed. And it'll take about 7 or 8 years for the transaction costs to be paid off. And then once all that's paid off, the company is essentially just going to generate cash that will enhance the value of the company over time, allow the company to make acquisitions, to grow itself, and to do the things that companies are dying to do because they don't have the access to the cash flow that a company that's not paying taxes does. So it's a real important thing. Think about yourselves getting a paycheck every month or every 2 weeks and not having to pay taxes on it. What could you do with that extra money? Well, the first thing you want to do is pay down the debt associated with what you bought, which is your house, let's say. Pay that down quickly, and then once that's paid off, then you can go out and buy another house or do whatever you want to do. And this is what the federal government allows you to do with an ESOP. So it's pretty unique, and it's a great opportunity for you folks. The former shareholders are still in the business. They're still actively managing the business. They're on the board of directors. Nothing has changed whatsoever from a management standpoint for the company. So there's a transition in the ownership of the business, but the management of the business stays intact. There's no change whatsoever on that front. So let's talk a little bit about what the ESOP is and what it's not. The ESOP is the employee stock ownership plan. Again, it's a special type of employee benefit. It comes out of Section 401, Section 401 of the Internal Revenue Code, where the 401ks come from. So it's very similar to a 401k, except for the primary purpose of this, two things really. One is the primary purpose of the ESOP is to buy stock in CHC. That's the primary purpose of it. There aren't going to be a lot of assets beyond that. So mutual funds are all in the 401k. You get a different variety of mutual funds. The ESOP's sole purpose is to own company stock. So that's number one. Number two is that, unlike a 401k plan, the ESOP can actually borrow money to buy the stock. And that's exactly what the ESOP did up front. To buy those shares from the selling shareholders, it borrowed money from the company. And then as that money gets paid back over a 20-year period, then it's going to allow you to take shares out of a suspense account and to give it to all the employees for that particular year that are participants. Let's see. 401k plan. Historically, the company has provided a profit-sharing contribution each year, and it varies each year depending upon how the company does. The company is going to stop making that contribution for the foreseeable future, and instead it's going to be making contributions into the ESOP to allow the ESOP to pay down the debt, then allows you to get shares in the ESOP as participants. You will, however, be able, and we still encourage you, to take your money on a pre-tax basis and put it into the 401k plan. That's a diversified plan. It's very prudent for you from an investment retirement standpoint to take money on a pre-tax basis, sock it away, invest it in mutual funds, knowing that on the other side you've got the ESOP as another retirement benefit that is going to grow hopefully over time and provide you with additional retirement benefit.
Jim?
Yes?
When you say foreseeable future, does that mean down the road when, say, the debt is paid down, that the ESOP or corporation could possibly make contributions to the 401k?
Yes. For those on the phone, the question is, I said foreseeable future, the company will stop making contributions to the 401k for the 401k plan over the foreseeable future. And that foreseeable future probably will be at least the point in time that all the debt associated with the transaction is paid off. Now, the debt associated with the transaction is about 7 or 8 years to pay that down, as opposed to the debt that the ESOP took on, which is going to be paid over 20 years. So it's a little bit confusing, and we'll get into that a little bit later on. But the point is that once all the transaction costs have been paid off over 7 or 8 years, then the company is going to have freed up a lot of cash flow that ultimately could be used by the company to go ahead and make additional contributions into the 401k plan. Okay, this chart shows you on a historical basis, to the left of that vertical bar, what the company had been contributing in hundreds of thousands of dollars, or thousands of dollars rather. This is what the company has been contributing to the 401k plan. So I told you before, if the company had not done an ESOP, let's say that this blue dotted line to the right of the vertical bar would represent nominally what we think the company would be contributing to the 401k plan. Okay? So that blue bar is essentially going to be going away for the next year, or several years I should say. And then ultimately, what the company is going to be doing is making contributions into the ESOP, and the value of the contributions you're going to be receiving in the ESOP is represented by this green dotted bar or line. So there are two things that are driving the value of that, or the slope of that line. One is the fact that you're actually getting shares. Roughly 5% of the shares are taken out of suspense account every year and given out to all the employees that year. And then secondly, the company's performing. It's paying down the transaction costs. It's growing its top line. It's growing its revenue line. It's making its operating profits or profitability better by reducing costs and expenses. So there are two things that are driving this: the release of the actual shares in the ESOP, together with the growth of the company and the pay down of the transaction costs. So the point here, and this is no guarantee, but the point here is that the value of what you're going to be receiving in the ESOP should be a lot more than the value of what you would have otherwise been receiving in the 401k plan. Any questions? Okay. So with ESOP companies, there are a lot of ESOP companies out there. There are 11,000 ESOPs representing about 1/12 of the overall workforce in the United States. Some pretty well-known ESOP companies, at least from a brand standpoint, are obvious. And then there are several ESOPs that are related to your business. There are actually a lot of ESOPs that aren't up here that are related specifically to the business that you folks are in. So the point here is that this is not a newfangled type of a retirement plan. ESOP's been around since 1974, and so they're pretty well established in the U.S. market. Yes, question.
How many of those companies are 100% ESOP?
That's a good question. The question is how many of the companies up here are 100% ESOP? And I would say that all the publicly traded companies, which are Kelly, Moore, Procter & Gamble, Stanley Works, the ESOP only owns a small piece because they're publicly traded and most of the shares are owned by the public. So those are not. These companies, the companies that don't have the brand names and they're related to your business, they're private companies, so I'm not sure. They don't disclose that information. But I bet you at least one or two of them are 100%. And just to give you a further appreciation, a bunch of companies that had done ESOPs for, let's say, 20 or 30% of the company, let's say 5 or 6 years ago, are now saying, okay, we're going to go to 100%. Because if you're 100% owned by an ESOP, you don't have to pay income taxes. So it's pretty compelling. So for the publicly traded companies, they can't do that because they can't be a specific type of corporation that you need to be. But some of these companies, I bet you, are 100%. The companies that are on the lower part of that list.
I'm pretty sure if you look at there, you got, Pleasance. I heard Pleasant. Dave, you were telling me that Chris finally sold all his shares. So Pleasance is now 100% ESOP. Chris Edmondson was owning some shares. So that's all. R.L. Detman's the B&G rep out of Detroit. They're 100% ESOP. Langley, I know, is, and Cummings Wagner is also. And most of these people were ESOPs. They went as the old partners retired. It was way buying the old partners. So that's pretty much what that happened with Pleasance and Detman and Langley and Cummings Wagner. Bradford White, who owns Lars, they were an ESOP. What is the difference? ESOP as opposed to ESOP.
An ESOP is the actual trust that owns the shares, and the trust has basically a game plan, which is the ESOP that has all the rules and regulations.
They've always referred to theirs as an ESOP.
It's interchangeable.
Okay.
Yeah.
So again, Lars, so that's the whole type of thing. You remember Lars was owned by Allegheny at one time. They were owned by Jandy. Those were all publicly traded, and they were sold to Bradford White. Okay. So.
Okay. Okay. So let's talk a little bit about, now we've heard about this ESOP. What are the rules? What does it mean to me? How do I need to manage myself going forward to know that I can get shares in the ESOP and ultimately get some value in the form of company shares? So there are really 4 things we need to talk about. Eligibility, when can you get into the ESOP? Allocations, so once I'm in the ESOP on an annual basis, how do I get some shares in the company? What's the mechanism that drives that? Once the shares are in my account within the ESOP, because you don't ever physically own the shares. They're owned in trust by the ESOP, or the ESOT, as Dave was talking about. And so you have it in name within the trust. But if you have to stay at the company for a certain period of time before you get to the point where you actually keep those shares and ultimately cash them out. And then finally, what is the cash out? What are the distribution rules? When do you get the cash associated with the value in the shares? So for eligibility to get into the ESOP and ultimately start receiving a benefit or an allocation every year, you have to complete 12 months of service with the company or work for 1,000 hours in a particular year. So if the rule of thumb is if you work for 6 months of the company, then you're going to be, that 6 months equates to 1,000 hours. So if you've been here at the beginning of the year and you work, let's say through the end of the year, you're going to definitely be over 1,000 hours if you work full time. The U.S. Department of Labor requires that all participants are United States taxpayers. So folks that are overseas, some of our clients have people that are overseas that don't pay taxes in the United States. In those instances, those people would not be able to participate. So an example would be someone who starts with the company on the 20th of March of this year. He works 1,000 hours, he or she works 1,000 hours. They would be able to become a participant in 2011 and receive a benefit or an allocation of shares in 2011. So now you're in the plan, and you're saying to yourself, okay, now how do I know how many shares I'm going to get every year? And that's what we call the allocation rule. And so you have to, once you're in the plan, you have to work for at least 1,000 hours in that particular year to receive a benefit. And if you leave the company because of death, disability, or retirement, even though you didn't make 1,000 hours, so let's say you retired on March 31st at age 65. Then in that instance, you would be able to receive a benefit for the first quarter, but you wouldn't have to go and fulfill this requirement of 1,000 hours. The contributions to the ESOP, or the allocation of the shares in the ESOP each year, are going to be based upon what we call relative compensation. So if I make $50,000 of compensation and Jane makes $100,000 of compensation, all other things held constant, Jane's going to get twice as many shares in the ESOP as I do. And so we divide it amongst the entire population of people that are participants for that particular year. We use W-2 compensation, which is when you get your W-2 stub every year, that's the compensation that we're using for your individual proportion compared to the entire pool of people. And I'll show you mechanically how that works in a second here. All right, so let's look at what a theoretical or hypothetical example would be of an allocation. So the company has 200,000 shares that were bought by the ESOP in mid-April. And again, those shares right now sit in a suspense account. No individual has any shares right now allocated to them. We're going to allocate these shares over 20 years. Because that's what the inside loan, the loan between the company and the ESOP. When the ESOP bought the shares, it didn't have any cash, so it basically borrowed the money from the company to do it. So it's going to be paying it back over 20 years. Roughly speaking, that means 5% of the shares that were bought are going to be allocated in any one particular year. The company has approximately $9 million of payroll for people that are going to be participants in the plan. And so what we do, let's take a look at employee number 2 here. They made W-2 compensation of $50,000 in 2011. We look at the $50,000 in proportion to the $9 million, and the fraction that we get is 0.56%. You take the 0.56%, multiply it times the 10,000 shares that were allocated in that year, and so this participant for this year, for 2011, will receive, in this example at least, 56 shares in their account within the ESOP. And so this is the first year. We roll forward. There were 105 employees for this year. The company continues to grow. It adds another 10 people to its payroll in 2012. So now there are 115 people that are participants. Let's say that the payroll has gone up to, I don't know, $9.25 million, $9.4 million. So that becomes the denominator. And so let's say your compensation in the second year was $51,000. So you take the 51 divided by the 9.4, get that fraction, multiply it times the 10,000, and that's what you'd be receiving in 2012. And we do this every year for 20 years. And that's how the shares are going to be allocated in the ESOP.
We need more shares.
Well, you know what? It doesn't, believe it or not, it doesn't make a difference how many shares there are.
Right.
Because so you get one share and that's 1/200th of the company. It's really, whether there's 2 million shares or 200 million shares, it won't make a difference. It's just a number that we use as a divisor. Yeah.
Was the 20 years set, or could that be accelerated?
The 20 years is the maximum time frame that those 200,000 shares can be allocated. The company could, doesn't have to, but it could accelerate that time frame. But the reason why it's 20 years in part is to smooth out the allocation, so that if you did it over 5 years, and then in year 6 some employees show up, new employees, they're saying, oh, all the shares are gone. Where are my shares? And the answer is, well, they've already been allocated. So we try to smooth it out, number one, so the employees in the future years get to participate. And number two is that we don't want all these shares to be allocated and then all of a sudden people start leaving and then all of a sudden the company has to come up with a bunch of cash to cash these people out.
Do they go with even number of shares, or is it percent, or is it like 3.1 shares?
It could definitely be a fraction.
Okay.
It can definitely be. So you'll probably see a fraction of, this could be 56.021 on your ESOP statement. So you're going to get a statement once a year, probably in March or April, telling you how many shares you received for the prior year. So in April or March of 2012, you'll be getting a statement saying what you received for the prior year.
Is that year based on the corporation's fiscal year?
It is, yes. So it's a calendar year. Any questions?
I did have a question.
Yes.
Does that start at the date of hire of the original employee? Some people were hired 30 years ago.
Right. We'll get into that in a second.
Oh.
So we'll get into vesting in a second, all right? Or maybe 2 seconds. It's 1 second. So these shares have been allocated. Let's say we're 4 years into this and you've had 4 years of allocations. And those shares are sitting in an account within the ESOP in your name. And then the question is, okay, I'm leaving the company. I want to get the value of those shares. Can I get all 100% of those shares, or am I going to get a portion of it? And so this is what is vesting. So vesting is your non-forfeitable right of ownership in your account. We determine vesting based on continuous service since you were hired at CHC. Each year, so we look at the number of years you've been in employment at CHC, each year you've got to work at least 1,000 hours in that year for it to count towards your vesting schedule. We'll show you what the vesting schedule is, but basically for the first 2 years if you begin with a company, let's say in March, you will have 2 years where you'll have no vested benefit, and then all of a sudden it starts popping up at 20% per year, and I'll show you a graph on that. For folks that are employees that die, become disabled, or retire at age 65, regardless of where they are, let's say that they started 2 years ago, they will become 100% vested in that instance. So that's important to understand that. So here's the vesting schedule. So if I started this year, I'd have to wait at least 2 years before I start receiving any vesting. So I'm going to be receiving an allocation this year. I'm going to be receiving an allocation actually in year 1, and in year 2 I'll receive an allocation. And not until after year 2 do I start saying, okay, I get to take some of that benefit with me when I leave the company. And that's when if I leave the company for reasons other than death, disability, retirement, because in those instances you become 100% vested. So this is the vesting. There's also a vesting schedule in your 401k plan. I'm not sure if it's actually the same as this or not, but it's the same idea. Question?
Does this start, because this started on April 18th, is that when the clock starts?
No.
So if you've already been here for...
If you've been here for 7 years, you're 100% vested.
100%, got it.
So you're 100% vested, but you're going to be, for this year, 100% vested in shares that represent a small amount, right? And then every year, you'll still be vested 100%. Okay? Okay, so we talked about vesting. So now let's talk about how do you receive the cash, the value of your benefit, because you don't physically own the shares, and you're not going to be able to take the shares with you as a result of that. So there's value there. It's a matter of how do you determine what that value is. So we look at distributions in 2 different ways. One is we look at the group that retire at age 65, they die or they become disabled. At that event, as we said before, they're 100% vested in whatever their benefit is, and they will receive the value of that benefit over the next 5 years at 20% per year. So if someone has 100 shares in the ESOP and they retire, then they're going to receive the value of 20% of those shares the first year after they retire, another 20% the second year after they retire, and so on. So that's for the people that retire, die, or become disabled. The other group are people that leave the company for reasons other than that, other than death, disability, and retirement. People that quit or are terminated. And those people have to first off see where they are on the vesting schedule. Let's say that they're 60% vested. And then that benefit, the 60% of those shares that they have acquired, will be paid to them after a 5-year break in service, and then 20% per year. So we really smooth that out. They're not going to get a lot of cash if they leave the company before retirement. They're going to get it. They'll get cash, but they're not going to get it right away. And they're also going to get a portion of their benefit if they haven't been fully vested. In my example, they are 60% vested. The 40% of the shares that are not vested are going to be forfeited and basically go back into the pot and are allocated to all the participants that are staying with the business.
What happens if you once you retire and then if you croak? Does it go to your family, or do you just lose it all?
Good question. So the question is, what happens to the benefit if you die? So you retire this year and you die 2 years later, what happens? You're going to get a form that's a beneficiary form that you're going to fill out saying, if I pass away, here's where I want this money to be paid to. So it doesn't all of a sudden just evaporate. It's going to go to someone that you want to benefit from that. Yes?
So if you're fully vested, you leave, you don't retire, you're not 65, but you go work somewhere else for whatever reason, what is the disbursement?
So you leave the company at age 60. You've been with the company for 10 years.
Right.
Okay? You've had 5 years of allocations of shares. Those allocations are 100% vested. You're going to get all of it, the value of it, but you're going to have to wait for 5 years before you receive your first dollar. Okay?
You wait
So
5 years before you get any.
you wait 5 years. It's what I call a 5-year break in service, and then you receive it 20% per year thereafter. Now, if you retire, if you reach age 65 and then go work somewhere else, there will not be a break in service. You would start getting the 20% per year, beginning with the first year after retirement.
Is the age 65 a hard number, or is there some benefit to staying longer, especially for people that are approaching that age?
Age 65 doesn't mean that you have to leave the company at age 65. You can work for the company after age 65.
And you continue to be part of the
Yes. You would continue to be part of the ESOP, yes. Is there another question? Yes. What determines it's 20%? The question is, for folks on the phone, the question is, how do you come up with the 20% per year? And that's what the federal law allows. So it's part of ERISA. ERISA says you cannot have it spread out more than 5 years or 20% per year. Question?
If you retire at 64, you have to wait until you're 69 to get your first equator.
That's correct. If you retire early, before the stated retirement age in the plan, which is 65. So if you retire at age 64, you will have a 5-year break in service before you receive your benefit. That is correct. So it's almost, you want to work to 65, and then all of a sudden that break doesn't come into play.
So when you leave, of course, you would not be allocated shares anymore. But then what would happen to the value of those shares?
That's a good question. So you've left the company. You're not receiving any more allocations because you're not a participant anymore in the ESOP. You're in that 5-year break period, let's say. Those shares are going the value is going to fluctuate. It's all dependent upon the stock price of California Hydronics. So for 5 years, you're going to be riding that stock price, which could go up or it could go down. And then, so in year 6, you've gone through your 5-year break in service. Year 6, you're going to receive 20% of your shares based upon the share price that year. Then the next year, 20% of the shares that you had originally times the value of the shares that year. So you do ride with it.
So the 20% goes up and down.
The value of the 20%
Right.
can go up and down. Yes,
So the amount would go up.
that is correct. The amount can go up or down.
Retire and it's so much. 5 years later, you start to get your 20%, and then it's not going to be the same amount next year.
Yeah, I think when you leave the company, it's probably a good bet that the value of those shares are not going to be the same when you start cashing in on them 5 years later, to the extent that you haven't reached retirement, died, or become disabled. Yes. So it will fluctuate. It's like the stock market, which goes up or down, and hopefully it goes up. Yes.
If you retired at 64 and you died at 66.
Is this a personal question? Yeah, really.
Whatever. If you retire before you're 64 or whatever it is, and then you die 3 years later.
Yes.
But you still have to wait, your family waits 5 years, or
you actually accelerate. So if you the break-in service is truncated by death, disability, retirement. So to your point, I apologize. If you leave at age 64, you'll have a 1-year break in service because you then reach the actual retirement age of 65. So you're right. I apologize. Sorry for that confusion. Yeah.
20% is the minimum. The minimum that the ESOP has to pay out. They could accelerate that if they wanted to, right?
They could, but if they do it for one, they have to do it for all. And there's also kind of a de minimis, I call it de minimis, but if your balance is $5,000 or less, then the company can say, you know what, we're just going to write you a check and not deal with the break-in service or with the 20% per year. But hopefully it's all going to be worth a lot more than $5,000.
But the trust at some point could modify those rules to have a more accelerated payment schedule?
The trust could make it more accelerated, yes. The plan could be actually amended to do that. You can make it more favorable to the employees, but you cannot make it less favorable to the employees.
A lot of these rules they're to protect yourselves also. There's reasons why you may want to spread this out. So it's to protect everybody in here. And also, I think there is some concern about if you retire, what happens to my money if these guys piss it all away. And I was kind of reading between the lines, and I could see that. So that there's insurance requirements that we have to have for fiduciary, the coverage, as far as we have to run the company properly. We can't just blow it, type of things. We can't invest in a hot dog stand or something like that and say, hey, we're going to do this. We have the management of the company has responsibilities to the company to run it, okay? And it's the board that selects us. And if somebody says, "Hey, Attard, you're out," I'm out. I mean, it really is. That's the way it is. We don't own this company personally anymore. It's a board of directors that'll be on the company. We're going to have 2 outside directors on the board. So it's a different ballgame that we're dealing with. So I'm saying we have a pretty good track record since '57, okay? And we're not about to blow that type of track record. Okay? Because everybody is holding our feet to the fire. Before, it was our company. Now it's our company. Okay, so just so I think I was kind of reading between the lines is what's going to happen to my money. I don't get it for 5 years, and these guys blow it. So.
Question.
Conversely, if the company is doing exceptionally well, can we limit it to the 20% buyback over the period?
So the question is, if the company is doing very well, can you accelerate it, or can you? I'm not sure.
Accelerate it. If the company is doing exceptionally well, gaining 50-100%.
You cannot decelerate it. You can't make what was 20% to 10%. You can't stretch it out over 10 years if that's what your question is. The answer is no. You can't do that. Okay. 2 other items on distributions. For folks, now this is off in the future here, but you've got to be in the plan for 10 years. So this is the first year of the plan. So 10 years from now, if you're age 55, you can ask the trustee to take 25% of your share balance and have that cashed out. And that would basically be either put into cash within the ESOP that you could have invested in mutual funds, or that 25% could actually be distributed to you and rolled over into an IRA account. Okay, so you get that option at age 55 for 25% of your shares, and then an additional 25% at the time you reach age 60. So those are what we call the diversification rules, but that's 10 years out from now. The last thing on distributions, as I alluded to earlier, so when you receive the benefit, you're getting these benefits put into the plan, this allocation of shares. You're not getting taxed on it because it's a qualified retirement plan. You will get taxed on it ultimately when you take that cash out. So when you receive distributions of the value, so that 20% per year, you get the check and you can roll it over into an IRA account at Merrill Lynch or Fidelity or something like that, and you can continue to defer it. If you take that cash and just deposit it into your regular account, then you're going to have to start paying taxes on it. And there's a penalty if you use that cash. I think it's before age 59 and a half. But just the fact of the matter is that you will pay taxes on this benefit at some point in time. Hopefully it's in retirement when you've got a lower tax rate. Yes?
Just for clarification, when we say in the plan, that means starting today or starting this year?
This year, 2011, is the first year of the plan.
Right.
Yes, and it's going to be the first year that you receive allocations in the plan.
Right.
Let's see. Where did my mouse go? Here it is. Okay. So we talked about distributions, we talked about allocations. Let's talk about the stock price. So the value of the benefit. Yes, before I go there, question. Did I skip a slide?
Yeah.
Okay.
Shares.
My apologies.
That was intentional.
Darn it, they found it. Okay. So, okay. Thank you for correcting me on that. So how's the value of this benefit determined? How are the value of the shares determined? Well, first off, California Hydronics, no surprise, is not a publicly traded company. You can't look in the newspaper every day and see what the stock price is. The shares are up front in the transaction that happened in mid-April, and then on an annual basis thereafter, the company, or I should say the trust, has an appraiser, a third-party independent appraiser that works essentially for the trustee, and their responsibility is to look at the value of the company and compare it to other companies like your type, compare it to publicly traded companies, and come up essentially with what they call fair market value estimate of value every year. So that person works for the trustee, doesn't work for the board, and so they've got a fiduciary responsibility of doing the right thing from that standpoint. And again, the stock is revalued annually, and sometimes it will be revalued more often, but I think in CHC's standpoint, instance, it will not be the case. All right, so now go to the slide that I tried to get to. So how does the stock price change? So the key thing that drives the value of the company are earnings, profits of the business. That's what's going to drive the value of the company. That, together with the ability for the company to pay down the transaction costs that were associated with the ultimate buyout that occurred in mid-April. Some of the things you don't control, general economic activities, and you don't control the fact that there is debt on the company's balance sheet that needs to get paid down over time, and it will get paid down over time with the company earning the profits. Things that you do control are productivity, growing the company's revenue, reducing expenses. And this is, again, the part where you have an influence on the value of your retirement benefit, unlike in a mutual fund.
Question on that last part. Who gets to, is it the board of directors that gets to dictate what the financial leverage or risk or, I mean, because that's obviously a big part of it.
Yes. So the board of directors have a fiduciary responsibility to the shareholder, which is the Esop trust. Remember, the trust owns the stock for your benefit. So the board of directors has a fiduciary responsibility to do what's in the best interest of the shareholder.
Are they guided by a percentage of value to debt?
No, they are not. There's no guidance. It's kind of the business judgment rule that the courts use, saying that if you have a company and all of a sudden you go, it's like your house. If you go willy-nilly and put 5 mortgages on it and you don't have the cash flow to do it, well, you haven't been very prudent, have you? So the board of directors, in looking at what the financial leverage of the company is, and the primary leverage is the transaction cost itself. And there are other pieces of debt that the company has that are associated with working capital and machinery and equipment. But the board of directors, their interest is paying down that debt. And there may be a prudent amount of debt that the company continue to have on an ongoing basis, like you would see in publicly traded companies. A lot of publicly traded companies, even though they've got a publicly traded stock, they still have debt on their balance sheet because it's prudent to have debt. It's a cheaper form of cost of capital. So it's the board of directors that makes that determination. It's not the trustee, it's the board. Okay, so the ESOP owns equity in the company, and there's no guarantee with equity. It's not like a bank savings account that has FDIC insurance. The price can go up, the price can go down. You do have an influence, in partially at least, in how the value of that stock is going to move on. Again, the stock price is revalued each year based in large part on the profits of the company. Increasing profits means typically increasing stock price, but if the stock market crashes, you might be increasing profits, but there is an influence from outside factors like the stock market. There are no guarantees that the price will increase. There are many ESOP companies that are tremendously successful. The employees understand that they're now, they've got a real motivation to work hard for the company beyond what they've already been doing. But it's a leveraged transaction. The company has a good portion of debt on the balance sheet, and there have been ESOP companies that have failed. And so the point of the matter is that you do the best you can to increase profits, increase revenues, and ultimately to pay down the debt as a result of that, and that's all that can be asked of you. So let's look at an example, just a little bit of quant here, of what it means to increase revenues and reduce costs for the company. And so in this example, we're just doing something very simple. Let's say in year one, the company has $60 million of revenue, and if the company can squeeze out just a 1% increase in revenue, so in year two, they've got $60,600,000, they've increased the revenue, their top line, by $600,000. Similarly, if they can reduce the expenses by 1% from $57 million to $56,430,000, they have a new savings of $570,000. You add the two of them together, and you've now dropped an additional $1,170,000 to the bottom line. Very, very back in the envelope, just to give you, it's much more complicated than this, but one of the ways that someone could very quickly try to determine the value of the company, and I can assure you the ESOP appraiser goes much more in depth than this, is to say, okay, we're going to take the profits, multiply it times 6 times, and that's going to be the estimated value of the company, $18 million. So in year two, because you've now increased your profitability by $1,170,000, you take that number by 6 times. Now you're at a $25,020,000 value. You've increased the value of the company by 39%. So pretty simple stuff. Increase revenues by 1%, reduce expenses by 1%, $7 million of value that go to the participants. Not to the former shareholders, goes to the participants. Yes?
I was going to ask, is 100% of the profit going back into the ESOP? Is that how that works?
That's the good question. So profits, right? We've got $3 million of profits, 4.1. Those profits are going to be, that's cash flow that's used to pay down first and foremost the transaction debt, transaction costs. So in those instances, the answer is no. It's not going in the ESOP. And after that, the company could keep that cash within its coffers. It's going to increase the value of the stock that you're ultimately getting. So whether it's in the company or in the ESOP, it doesn't make a difference. Most companies keep it within the company because if you want to go out and make an acquisition, you've got the cash to do it. If you want to go out and buy some machinery and equipment or build a new warehouse, you've got the cash, as opposed to once it goes into the ESOP, it's tough to get back. You can get it back, but it's a little bit more complicated and more expensive as a matter of fact.
Is that 6 times multiplier, is that some industry standard, or where?
It's a rule of thumb. It's a rule of thumb that we see being used. I mean, this is a pretty simplified example. It's much more intricate in terms of the actual valuation, but when you actually go through all the machinations of what the valuation is, it's like rule of thumb, 6 times. Profits is somewhere in the ballpark.
Some companies have real estate and some don't. So that's
right.
A huge difference right there.
And some companies have a lot more debt, because what I didn't say is that from this number, really, you would subtract the amount of the transaction costs or debt that you've got on the balance sheet. So I simplified it down a little bit just for ease of illustration.
1% matters.
1% matters. It definitely does. Trying to kind of bring it home a little bit more, if you have an employee that makes $45,000 in annual compensation, this chart is trying to illustrate, hypothetically, if the company is allocating shares, or sorry, the ESOP's allocating its shares and the stock price is growing, what the value of this benefit is over time. So you've got a $45,000 employee. They start out with small bits and pieces in the first several years, and then the company starts growing. It's paying down its debt. The company continues to grow. At the end of 20 years, they've got essentially 10 times their annual compensation in the ESOP. It's a pretty darn good benefit relative to what people typically get in a 401k plan. In a 401k plan, it's probably going to be more like somewhere around here. But you've got this very large benefit. But there are two things that are driving this. Actually, three things. One, staying with the company over this period of time. Two, receiving shares, which is tied to your compensation relative to everyone else's compensation. And three, increasing profits and paying down the debt, driving the stock price up. Absolutely no guarantee that this is what someone's going to be receiving, full disclosure. But it's an illustration. It could be higher, it could be lower. Again, no guarantees. The ESOP is 100% owner of California Hydronics. There are no guarantees. The ESOP is really a reward for the continuing success of the business. The shareholders, the former shareholders, had several options with regard to the ownership transition of this business. They could have sold it to a third party. They could have sold it to a private equity firm. They could have done what they call a leverage recap. They chose to do an orderly transition whereby you folks will be the ones who get the benefit from the ownership, and not some stranger riding into town buying the company out. So I think if I were you, I'd be very grateful that the shareholders, the former shareholders, decided to do that, because sometimes when companies are bought and sold, there's a lot of transitional issues that go on, and those things are not going to happen here because the management and the overall governance of the company has not changed at all. Housekeeping issues. You'll receive, first and foremost, a summary plan description, which is about a 25-odd page document that is almost like the Cliff Notes version of the actual plan document, which is about that thick. So this gives you kind of a summary of what the terms are. It talks about vesting. It gives you examples. It talks about how you become a participant and how you receive your benefits. So you'll be receiving this. You'll also be receiving annually a statement that you probably won't be making heads or tails out of, because it's the federal government saying you've got to report this to the employees. But basically it's the balance sheet of the ESOP. It's not the balance sheet of the company. It's the balance sheet of the ESOP, showing you what the assets are and what the debt is in the ESOP and so forth. But you really won't be able to make heads or tails of that. And then finally, you receive a statement once a year that tells you how many shares you received, what are the total number of shares you've received over several years of allocations, what the price per share of the stock is, and then what portion of your benefit has been vested. So those are the things that are required to be given to you each year. Additional information on ESOPs can be found, and again, this presentation I think is going to be put on your website. ESOP Association is a national association that has all kinds of ESOP companies in it, and you can go on the website and learn a lot about ESOPs. The National Center for Employee Ownership is a West Coast based, I think they're out of Berkeley, and that's a group that does a lot of great work with educating employees about what it means to be an employee owner and so forth. And then SES Advisors is our firm. We've got a lot of information on our website as well. Let's see. I think. So that's the end of the formal presentation. There were several questions that were provided over the last several days, including up in Vancouver yesterday.
So we had somebody that represented the owners on the ESOP. So the ESOP, basically it is the owners, the prior owners of the company, sold their shares to the company. And it's all regulated. We have people that represented the owners, we had people that represented the purchase, we had an outside trustee,
Yes.
which was Dan Reeser.
Dan Reeser, yep.
And so what we're going to do today is go over what everyone needs to know. A lot of people have already proposed questions to Donna. We've incorporated it into the presentation. If the questions are not answered, ask the question. Do not come later and say, you know, what the heck was this guy talking about? Even if you want to, if you come up with a question later, present it to Donna. We will get your questions answered. We're going to have something on our website, our intranet, which is going to be posting a lot of the questions, a lot of the information. Bob Polizzi is going to videotape the presentation today, so we'll have the answers for everyone. We'll be able to re-look at it. What did he say? So we're I don't want to use the word above board, but we want to make sure it's clear to everybody, because now we are all employees of this new ESOP, and we're all working for it, and our goal is to what? Make money for the company, make money for yourselves, make money and be a successful company. Okay? So Jim, I'm going to let you go on from there,
Yep.
and questions going to be open, so don't. If you have a question, write it down so you won't forget. Okay? Thanks, everybody.
So that's the end of the formal presentation. There were several questions that were provided over the last several days, including up in Vancouver yesterday. So I'll go over these questions, but by all means, if you have additional questions, please put your hand up. So, first question, how many shares does an employee start with in the ESOP? So right now, the ESOP's already started. No one has any shares whatsoever. So we'll wait for 2011 to close out, see what your total compensation is, see if you're an actual participant, you've met the 1,000-hour requirement, and then next March or April, you'll find out how many shares you received.
What's compensation?
The defined term of compensation is W-2 compensation. So we get your W-2 stub in January. The number that you see there is the number that is going to be in the numerator, and the denominator is the W-2 of all the people that are participants for that year.
So it's wages, bonuses?
Wages, bonuses, commissions, things of that nature, yes.
So it doesn't go back to last year for this year?
No, it's going to be 2011 your 2011 W-2 compensation is what's going to drive the number of shares you're going to be allocated for this year. And then 2012, it's going to be based on your 2012 number. So it does change. The numerator, meaning your compensation, probably changes every year, and the denominator, which is everyone's compensation, definitely changes every year.
But, hey Jim, the first statement everybody gets is a year from when this started, not December 31st.
You're going to get your first statement probably in March or April of next year. The reason for that is we have to close out 2012, see what your compensation was. We're going to see how the company actually performed, because then the appraiser in the January-February timeframe is going to do the work looking at 2012 to come up with their valuation of the company as of December 31st, 2011. And then that value is that per share value is then put onto your statement and multiplied times the number of shares you've got to show you what the value of your benefit is.
But that value doesn't change the number of shares that are dispersed each year?
That's correct. The valuation, the appraisal is independent of the number of shares that you would receive for a particular year. Okay, let's see. Are employees no longer able to put money into their individual 401k plan? The answer is you are absolutely encouraged to put money into your 401k plan, because again, the ESOP is undiversified. It's a single asset type of stock plan. And 401k, you can put in all kinds of mutual funds that are diversified, and that's really a prudent thing to do from an investment retirement standpoint. The question before was what profit goes back into the ESOP, and at least for the next several years, no profit's going to be sent to the ESOP. The company's going to use the profits to pay down the debt first. And then it may retain those profits going forward, or it may distribute it to the ESOP. How are the shares taxed? We talked about this before. When you receive your distribution, so that 20% per year, you're going to receive a check, and you can roll that over into an IRA account, and then ultimately when you start drawing off that IRA account, you're going to get taxed at that point in time. Can we, the employees, purchase shares? So can we take money out of our own pocket and put it into the ESOP? And the answer is no. you cannot do that. This is completely funded by the company. If you want to put money into a retirement plan, you put it into the 401k plan. You cannot put it into the ESOP. What is the value of the share and how is it determined? Right now the value of the share, I should say, the value in mid-April was $6.71 a share. And that, with increasing profits and paying down the debt, will ramp up quickly, hopefully, to a much higher number than that. But right now it's $6.71 a share. And the ESOP appraiser, again, in January or February of next year, will look and see how the company did in 2011 and determine what the value was at the end of December. If I retire in 6 years, will I get something from the ESOP equal to the 401k? So if the ESOP hadn't done if the company had not done the ESOP, you can assume you would have gotten something in terms of every year, let's say, from the company in terms of profit sharing, as compared to the ESOP. And if you recall that chart at the beginning where we had the green dotted line versus the blue dotted line, if the company does continue on the flight path that it has been over the past several years, you can assume that the value of your retirement benefit is going to be higher given the ESOP as compared to the 401k. What happens if there is a mass exodus of employees from California Hydronics? So if all of a sudden you guys just decided... Pardon? I'm sorry, I didn't hear you.
I mean Columbia Hydronics.
Good point. You know, the fact is that the rules of the ESOP, such as the break-in service and the vesting, tries to dissuade people from leaving the company in total. This is a long-term retirement plan. If a bunch of people leave 2 years from now, they're only going to get 2 years out of the total 20 years of allocations in the plan. So we try to make this a nice long-term benefit that you're going to be persuaded to stay here and work hard as opposed to pick up and leave. If people do leave, they're going to lose shares possibly because of vesting, and they're not going to receive their benefit for several years. So they will receive a benefit, but they're going to be held back for a while. Do you need to be a certain age to retire or receive payment? Again, I think to one of the questions back there, you could retire at age 63 or at age 64. But you've got to see where you are in the vesting schedule because you haven't reached age 65, which is the retirement plan, and there may be a break in service as a result of that as well. If an employee is not 100% vested, how can they be certain that the management won't terminate them in order to save money? Get all types of questions. First off, they'd be violating rules with the Department of Labor, so they're getting themselves in the hot water. So that the managers would not be in good stead with the Department of Labor if they say, oh, you know what, this person's 5 years and 11 months, they're just that short of getting to a full vesting, so we're going to terminate them. So that would not be a good thing to do.
What's the name of that questioner?
It's all anonymous, but it's a good question. And so the fact of the matter is the company can't save money by terminating a person or firing a person prior to the time that they're about to reach full vesting. Because what happens is those shares, if they do terminate it and the management team gets away with it, those shares are basically going to be forfeited. Let's say the 20% that they were 80% vested and they didn't get 100%, so that 20% differential, those shares get reallocated to all the people that are sticking around. So those shares are going to get cashed in at some point in time anyway. So there's really no game that you can play in terms of saving money for the company. Speaking of which, how do shares get reallocated if an employee forfeits them because they were not fully vested? So again, I'm at 80% vested, I've got 100 shares, that means I'm going to be able to keep the value of 80 of those shares, but 20 shares are going to be given away. I'm not going to be able to take those or get value on those. So those 20 shares in the year that I leave, or a couple of years after I leave, I think it is, those 20 shares are going to be held in suspense and then reallocated to the employees within that period of time that I've left. Yes?
Can I ask if shares are distributed in whole numbers, or is there some fractional shares?
The question is whether the shares are whole number shares or fractional. They're fractional. So it could be 2.395 shares that you're going to receive. And that's it. Any other questions? Question in the back.
said the shares are based on your W-2 compensation.
The allocation of the shares that you receive in a particular year are based upon your compensation.
Base compensation?
It's total compensation.
So obviously, the more you work,
The more you make, the more that is going to go towards putting more shares into your account. There is a cap that the Department of Labor, no, the Internal Revenue Service puts in place. So if you make more than $245,000 in 2011, you're not going to be able to get anything above that. So it's,
is the distribution of shares based on the calendar year? Is that how that works?
is the distribution, yes, is the distribution of shares based on the calendar year. You will receive, if you retired this year, let's say you retired today and you had several shares or hundreds of shares, whatever it might be in the ESOP, you reach age 65, you will receive a check sometime, I think, in the first 6 months of 2012.
But if you work, say,
I can't-
hours in this year, you would get your shares for this year.
I'm sorry, can you repeat that?
If you work this year over 1,000 hours.
Yes.
You would, in December, regardless of if you stayed or not, get your shares allocated for this year.
Yes, based upon your compensation for this year.
Okay. Got
Right.
it.
Yes.
We talked about a few times this 7 to 8 years of time for the profits of the company to pay down the debt owed to the trust. What, is it 7? Is it 8? Could it be 10?
The schedule is 8 years, but it's scheduled for 8 years, but we're expecting that if the company hits what everyone anticipates it to do from a financial standpoint over the next several years, it will be able to prepay that debt sooner rather than later. So it could be 6 years.
But there's a mechanism in place if we have, heaven forbid, another 2008 or something, then it could go to 10 years. We've basically structured the debt for an 8-year payout, knowing that under normal circumstances the company should be in a good position to be able to prepay that. If the company falters a little bit, it's kind of, we've stretched it out enough that hopefully it won't impact the debt structure. Follow up, what's the cost of maintaining the trust? So you mentioned there's appraisers, there's trustees. What's the cost to the trust to maintain this?
It's a cost to the company for really 3 things. One is the trustee. The other is doing the record keeping. There's annual record keeping, like the statements that are being produced, and the ESOP trust has to produce tax returns and so forth. So that's what we call third-party administration. And so then the appraiser, third-party administration, and then the trustee. I don't know. You're talking about $25,000 a year. In the overall scheme of things, it's not a huge expense at all.
And that's a trust cost?
It's a company cost. It's a company cost. It's not paid for by the trust.
These get paid by the profits of the company?
It's an expense, just like health insurance is an expense, just like office space is an expense. It's part of running the business, and it's paid for by the company.
And what about the 20-year? The other, yeah, we had a 20-year loan.
Yeah, the 20-year loan is driving the allocation of the shares. So essentially the transaction costs are going to be paid out over 6, 7, or 8 years. But the ESOP, when it bought the shares, had to borrow money